In this video, I want to talk about 3 turnaround stocks YouTubers are saying to buy right now. So it could be a good opportunity to buy the dip and potentially some more upside in the long term. My name is Pierce. I'm the founder of InvestorWaves.com. We track top investors across YouTube, across newsletters, and things like that. And in the last few weeks, we've had one trader up 60%, another up 23%, and another up about 19%. So the first stock will be a $4.75 billion company, down 75% in the last 5 years with about a 4x potential. The second stock is a $6 billion company, down about 84% all time as an attractive dip buy opportunity. And the third stock is a $1.7 billion medical research company, which is down about 30% in the last a few days and down 87% this year, that some of the top investors are putting a large chunk of their portfolio in. So getting right into it, the first stock is going to be Fubo. So ticker symbol FUBO. You can see it's down about 75% the past 5 years, currently trading at $3.68 per share. And I mean, at one time this traded at $30 a share even. So it's gotten beat up a lot in the past few years, but Jeremy here from YouTube actually says this is a great turnaround and tactical buy opportunity for Fubo because it's a little bit less speculative as time goes on, and it is a speculative hold he says, but he's been buying it in the last day or so, and the stock's currently under $5, but he believes it could go to a near-term price target of $5, $10, even $20 per share. And he believes really that the fundamentals are getting stronger, which they are. They reported earnings revenue here in Q3 of about $369 million, which is down 2% year over year, but their subscribers are up, right? 1.63 million paid subscribers for the TV product there, and they just had this big merger with Disney. Disney now owns about 70% of the company, and so this could be a reason why their paid subscribers are up. Right now, they can benefit from this ecosystem where they have Disney, Hulu, ESPN, and they can offer a better product to their subscribers. So Fubo is a brand to watch here as a turnaround, and this Hulu and Disney deal, forming this combination, is one of the largest live TV streaming services right now. And it does feel like in the last few days, if you're an NFL fan, that sentiment is kind of turning on the streaming, as people were paying for YouTube TV and they couldn't cut a deal and they lost out on Monday Night Football. So it does seem like some negative sentiment right now, and if Fubo and Disney, if they can find a gap in the market there to find a specific offering at the right price. I believe they're kind of selling their sports and news package for about $55 a month. But if they can carve a niche there, there's opportunity. People switch streaming services all the time, and there's no reason they can't continue to grow if they find the right offering. So tapping into this ESPN ecosystem and could be something big. And their CFO came out and said that Fubo Sports is going to be their skinny bundle in over 100 U.S. markets, and they're going to be really expanding and kind of attacking a larger market when it comes to streaming. So they want better retention, they want lower churn, and all these things. Go check out this article from the Hollywood Reporter, but that's going to be Fubo. And really, Wall Street analysts says they don't quite have that price target of $10 or $20 per share, but they have a consensus 1-year price target of $4.50 on this company. So that would be larger from where it is today at about $3.58, $3.68. So that's going to be stock number 1 of Fubo. And every day I actually send out 3 stock ideas I extract from these internet investors to your email completely for free. If you want to get that, just click on the link in the description and enter your email to receive that. So go ahead and do that now. And let's get into stock number 2, which is Mara, M-A-R-A. So this is another stock that's been kind of beat up in the last few years. In 2021, it was trading about $75 a share, even way back in 2014-15, up to 133 billion. So it's a $6 billion company. It's right in that mid cap range. And I've talked about them before. And what's so interesting about this company is that they are a Bitcoin company, right? They are a Bitcoin miner, and they actually recently reported earnings of a 92% year over year increase, up to 252 million in revenue. But despite all this, shares are still falling. And that's because they own so much Bitcoin, right? Back a few weeks ago, they actually had a significant purchase of about $46 million of Bitcoin. So their price is very strongly tied to Bitcoin price. So if we go and look at Bitcoin price over the last month or so, it's down 17%. And if you look at Mara in the last month, it's down 19%. So it's closely tied to Bitcoin despite them beating these estimates. And Stocks with Josh here says this is a great dip buying opportunity with strong support. They reported record earnings. They have had a sharp turnaround. They were actually very unprofitable earlier this year, but they've kind of increased their lower power cost and some of their other expenses to turn around from that $125 million loss earlier. And so this is kind of a huge moment for them in terms of their business fundamentals. And they're also part of the AI story, right? They're not just in the Bitcoin mining operation, but they're kind of secretly hiding this AI empire where they're acquiring and becoming more involved in these AI data centers. And I recommend go checking out this article here. This was posted on October 11th on Seeking Alpha, but talking about how Mara Holdings actually has a great opportunity to not just be a Bitcoin mining company, but really insert themselves into the AI discussion as well. And we've seen how AI stocks have done over the last year, right? So he says successful AI monetization could double Mara's valuation, in which this was written before this dip. So maybe it's even a triple now, 2 to 3x potential there if they kind of fulfill their potential in the AI sector. But getting back to the Bitcoin conversation, while they did gain and beat earnings and have this great Bitcoin mining operation earnings, from an earnings standpoint, they did have a lot of concerns about a Bitcoin sell-off that they had. And what essentially happened is they transferred over 2,000 Bitcoin, and that raised fears in the market that they are selling off some of their Bitcoin. So if you look at this article from, if I can find it here, about Mara, here from CoinSpeaker, they said they dumped 236 million Bitcoin, but I haven't been able to see if they've actually sold it or it was just a transfer, because what they did was they transferred over 2,000 Bitcoin into some sort of exchange, including Coinbase, Galaxy Digital, FalconX, and 2Prime. And so this really raised alarms across crypto and investors in the stock, despite these Q3 earnings results. So it'll be interesting to see if Bitcoin can hold a floor here at about 100,000 and not dip below, because it could be even more trouble for Mara if obviously it's reliant on Bitcoin if they hold so much of it. You can see that they are currently, or they were at one time a few weeks ago, they probably still are, I'll have to get an updated screenshot of this, but they were the second company in terms of holding the amount of Bitcoin. Obviously nowhere close to MicroStrategy, but they hold about 50,000 Bitcoin, and if they're selling off and the price keeps going down, it's going to continue to affect their price. So that's obviously the risk with this company. But in terms of a fundamental perspective, their long-term health, they're keeping their expenses down, they're improving revenue and improving mining efficiency and everything like that. So those are all the bull takes for Mara, and it's really a interesting dip buying opportunity right now. So that's Mara, and let's get into the third stock here, which is SRPT, Sarepta Therapeutics. They actually are down 32% in the past 5 days. Also down 58% all time. They were trading, many years ago, up $160 a share, $150 a share, and they've really took a turn for the worse in the last 2 years, which is unfortunate to see. But one of the most notable medical and pharmaceutical kind of medical field investors, Martin Shkreli, actually came out and said that this is about 40% of his portfolio right now, and he is buying the dip aggressively. He was buying at $18 a share, and it's currently sitting at about $16.20 per share. But they came out with earnings just a few days ago, and it was actually better than analyst expectations at an adjusted loss of just 13 cents per share. But posted revenues are $399 million and all of these things, but despite beating estimates and despite the revenue approximations, they had this huge 30% dip. And this is attributed to the trial data for one of its treatments and the impact on the timelines and approval and regulatory and all these things. So fundamentally, from an earnings perspective, not bad, but this kind of reaction from Wall Street is based on this trial data. So it's on these failed tests. You can see here, talked about Investors Business Daily. They basically said Monday that the FDA granted a approval to 2 treatments, but there's evidence of positive risk benefits in treating one of the diseases they treat, but both drugs are on the market with accelerated approvals but failed their confirmatory studies. So that is SRPT, and you really need to, if you're going to look into buying this dip opportunity, educate yourself on these drugs, these treatments, their products, and if this dip buying opportunity is an overreaction a little bit, because you look at Martin Shkreli. He comes out yesterday and says he still likes it. It's been a hell of a year for them. And he basically came out and says there is no debt really on the company, and they have about $1 billion in revenue no matter what, despite these failures, and they have the pipeline, and the stock should double as the dust settles. So that is his position. He's holding firmly and strong on this. But SRPT is kind of a thing where really the industry, investors can get fatigued and stressed toward a ticker if drugs have these failed confirmatory trial results. Here's some more information on it. From 2016 to 2025, there were 42 accelerated approval drugs that had a negative or failed confirmatory trial result, and only 7 were withdrawn while 35 remained on the market. So the withdrawal rate is actually less than 10%. So this comment here says this could be a little bit more fatigue and stress towards the ticker, and he actually picked up more shares to bring his average cost back down. So it could be a good time to buy the dip on this company. And there is one firm, Mizuho, who actually has a price target of $26 per share, which is up 36% compared to where it is today. So this is stock number 3, another potential beat up turnaround stock that's getting beat up the last few days. So go do your own research on this. And one last time, click on the link in the description to get these 3 stock ideas per day to your email, and enter your email there. And let me know what you think in the comments about these 3 stocks, and I'll see you in the next video.